Good morning all, and welcome to this Shine Wing webinar from wherever you are. We hope that you and your families are well, and for those of you with kids, you're all keeping sane. My name is Matt Birrell. I'm a partner in the National Tax Practice of Shine Wing, and I will moderate this morning's webinar and a little bit more. Today's topic centres on the government economic and stimulus packages, probably now more correctly called survival packages. Today, we have three presenters from the Shine Wing National Practice. James Yeh will present on the federal government income tax announcements. Blake Rodgers will present on the ATO administrative concessions. Tony Principe will present on the Victorian, New South Wales and Queensland relief packages. In addition, in reserve, just in case, Simon Tucker, a partner leading our technical division, will add some special comments and will lead the Q&A discussion. A couple of housekeeping matters before we begin. To enhance the webinar experience for all, and given the amount of people online, we've had to mute your phones and systems. However, we very much welcome and appreciate any questions that you may have. Please send these to us using the Q&A button, which should be at the bottom of your Zoom screen, or please use the open chat button. I'd also recommend that you go to full screen mode to enhance the experience. As I've said, this webinar, only because of time constraints, will concentrate on the tax concessions and incentives announced by various levels of government. It would be remiss of us not to also mention other government announcements that don't impact the tax base, but aim at injecting liquidity into the market or saving jobs or providing solutions for the rental market. We do want to touch on these measures, probably in the Q&A. However, given the freshly made announcements of last night, it's quite impossible for us to ignore the JobKeeper payment scheme. So what is this and how does it work? In summary, businesses will receive $1,500 per fortnight for each eligible employee. Which businesses qualify? Well, businesses impacted by coronavirus. For those businesses with a turnover under $1 billion, they need to show that the coronavirus has decreased turnover by 30%. For those businesses with a turnover over $1 billion, they need to show that the coronavirus has decreased turnover by 50%. We need to see the fine print on how turnover is defined. The fact sheet doesn't use the expression aggregated turnover like other measures have. This may mean that turnover is limited only to Australian turnover and not worldwide group turnover. In terms of who is an eligible employee, well, they need to be on the books at 1 March 2020. They don't need to be full-time. They could be full-time, part-time, long-term casuals, or stood-down employees. They must be Australian citizens or a holder of certain eligible visas. So how does the scheme work? A business will need to apply and to prove that they qualify. The business will then need to be paid the amount monthly by the ATO, and they will have an obligation to on-pay this amount to the eligible employee. Simple. Something like this would normally take a year to work out. This has been put together pretty quickly based around some pretty sound principles. The fact sheet is helpful, but there are many questions that we have, and no doubt you will have on its actual application. We'd welcome further discussion and dialogue with you on this. So please send through any Q&A you have, and I'll pass those on to Simon to answer. I'd like to move back now to the tax concession announcements, some of which now sound like ancient history. I will hand you over now to James Yeh, a colleague of mine in the tax division, to discuss these. James.
Thank you, Matt. Thank you for that. Let me just bear with me while I bring up my slides. Just bear with me 1 second. So as Matt has mentioned, what I'm going to talk about today with everyone is the income tax stimulus measures that have been released to date. These mainly include the cash boost, the extension of the instant asset write-off, and the accelerated depreciation measures. On the whole, depending on the size of your business, and this is measured by the turnover test, some or all of these measures may apply to you. So let's get down to the nitty-gritty. The cash boost for employers is a $31.9 billion package. It gives up to $100,000 over 2 tranches to small and medium businesses that are established before 12th of March that employ staff. For each tranche, there should be a minimum entitlement of $10,000 and a maximum of $50,000. Now, eligibility is determined by the size of your business, which is measured by this concept of your aggregated turnover. It's important to note that aggregated turnover is determined on a global group basis and includes all of your affiliates and connected entities. So therefore, unfortunately, for businesses that have a small presence in Australia but are large globally, you may not be able to access the cash boost. However, the good news is that although the turnover is grouped, where you are below the 50 million, the cash boost can be paid into more than one company in the group without limiting entitlement. Payment of the cash boost should be automatic and is basically delivered as a credit in your activity statement. Now, there is a rather involved methodology for working out how payment is actually delivered. And I've tried to sort of illustrate that in this table here in sort of as much detail as possible. So I'll try to run through it with you guys as well. If you've got any questions about this, please ask at the end and we'll try to answer. So basically, the payment methodology differs depending on if you're a quarterly activity statement lodger or a monthly. For the quarterly activity statement lodgers, tranche 1 refers to your March quarter and your June quarter activity statements. So basically, for these quarters, you get up to 100% of your salary and wages tax withheld. So even if you don't actually have any salary and wages withheld, but you do have staff, you still should be able to get a minimum $10,000 per tranche. So for amounts greater than that, so for example, where you have a quarterly salary and wages tax withheld of $30,000, then by this particular methodology, for the March quarter, you should be able to get the full $30,000. And for the June quarter, you get the remaining, which is the $20,000, making up the maximum of $50,000. For the second tranche, you should be entitled up to basically 50% of your total tranche 1 entitlement each quarter. So for the June-September quarters, theoretically, that should be $25,000 each quarter, making the maximum of $50,000. For the monthly activity statement lodgers, it's a very, very similar methodology, but adjusted for the fact that it's a monthly activity statement. So for tranche 1, for your March quarter, for your March month activity statement, you get up to 300% of the salary and wages tax withholding. So what actually that means is if you are withholding $10,000 per month for the month of March, you should get $30,000, and for the remaining April and May, you should get $10,000 each, making up the maximum $50,000. For tranche 2, the methodology here is you get 25% of your total tranche 1 entitlement each month. So what this means is for tranche 2 months, which go from June to September, you should get each month basically $12,500, which again makes up the total of $50,000. So hopefully that kind of illustrates a little bit how this works. Again, if you've got any questions about this, please feel free to ask and we'll answer it at the end. Now just moving on to the instant asset write-off. So this is basically an expansion of the existing rules that are in place and allows 100% immediate tax write-off of the asset purchased. So through this expansion, the asset cost threshold has now increased to 150,000 and the eligibility turnover threshold has increased by a lot to 500 million. Now this is a much, much higher threshold, and that means that the instant asset write-off should now apply to probably 99% of the Australian businesses we have. Multinationals, however, should still carefully assess your global situation to work out if you are eligible. So essentially, if you purchase an asset for business use and have it first used or installed ready for use before 12th of March, and between 12th of March and 30 June this year, as long as the asset has cost less than $150,000, you should be eligible. So the asset could actually be purchased prior to 12th of March in certain circumstances, and you should still be eligible as long as they're first used or installed from the 12th of March. Now, due to some legacy issues in the law, the eligible date of purchase actually differs based on the size of your business. And I've tried to sort of lay that out here in the table here. So for the smaller businesses, you have an earlier eligibility date for when you can make a purchase from. So it's very important to note here that both new and used assets can be eligible for this instant asset write-off. So so what that means is it's actually very beneficial in that you can get an instant asset write-off for both new and second-hand assets. And again, the threshold is a very high threshold, so this is a very beneficial measure. However, we should know that after 30 June, and in the absence of any other relief measures that may be announced, the asset write-off threshold will revert back to $1,000, and the turnover threshold for the business will decrease to 10 million. So after 30 June, unfortunately, it would only be small businesses that can actually be eligible for this. Okay, so let's just put this into practice, and I will quickly run through an example that's in the Treasury notes. In the Treasury fact sheet, we have Sam's Specialty Roasters that's got an aggregated annual turnover of 150 mil for the 2019-20 income year. So clearly that falls within this threshold. On the 1st of May 2020, Sam actually purchases 5 new conveyor belts for a production facility, and it cost $40,000 each for each of these conveyor belts. Again, 1st of May falls within the time frame. Under the existing tax arrangements, she's actually not eligible for the instant asset write-off and would have to depreciate the assets over 15 years. So if she uses the diminishing value method, she can claim a total deduction, a tax deduction of about $4,500 for the 19-20 income year. However, under this $150,000 instant asset write-off, she would now be able to claim an immediate deduction in the 19-20 year of $200,000, being 40,000 times by 5. So again, that's a much higher deduction that she can claim, 195,000 pretty much extra, and tax effective, that would be almost 60,000 that she can claim extra in the 19-20 year. This is a very preferential arrangement, and what we want to know is actually what happens if you don't actually fall under the instant asset write-off provisions. You can also look to see if you fall into the accelerated depreciation provisions. So how this works is it still actually gives you much needed relief, probably not as much as instant asset write-off, but it's still a pretty good relief. The good news is that there's actually no cap on the cost of the asset. The key distinction here is that the accelerated depreciation only applies to new assets and does not actually apply to second-hand assets. So that's something to know. Therefore, if you bought a second-hand asset that costs more than $150,000, then unfortunately you actually can't fall into either measure. Although not quite as good as the instant asset write-off, under the accelerated depreciation, you can still write off 50% in the first year, which would still be a good big amount if you're talking about a very costly asset. The remainder will be depreciated under the normal rules over the effective life of the asset. The measure should apply to depreciating assets that are used for business purposes purchased after 12th of March this year and first used or installed by 30 June 2021. So this is actually a 15-month window compared to the 3 months for the instant asset write-off. So it's actually a lot longer. Contracts that are entered into that are pre-12 March, unfortunately, actually don't qualify. So try to lay out a summary table here for both of the measures, just for your reference. Lastly, I just want to quickly touch on the Trainees and Apprentices wage subsidy. This is a much smaller wage subsidy that was announced quite a while ago, and it applies specifically to trainees and apprentices. So essentially what happens here is if you're a business and you have less than 20 full-time staff, then you should be able to access this particular measure. It gives a further cash flow, basically equal to 50% of the apprentice or trainee's wage that are paid between the 9 months from 1st of Jan this year to the 30th of September. The maximum subsidy that you can get is $21,000 per trainee, which equates to $7,000 a quarter. And the trainee would have to be in training as at the 1st of March. Now, the good news is this particular measure is actually not tested for turnover. So you could be a multinational with a smaller operation in Australia, and you might still be able to qualify for this if you satisfy the employee number test. So I've tried to take you guys through the income tax measures here in some detail. Again, if you have any questions, please feel free to ask and we'll answer at the end with the panel. And just handing back to you now, Matt.
Thanks, James. And I do see a lot of Q&A coming through, which we're collating and hoping to ask the panel shortly. And they're terrific questions. I'm not sure we're going to have all the answers, but we'll certainly try and provide some guidance to you. Well, the ATO has responded with their own relief package of sorts. To take you through these concessions, I'll hand the control panel over to Blake Rodgers, a senior member of our business, services and consulting team. Blake.
Thanks, Matt. This next section of the presentation relates to the Australian Taxation Office's administration relief and the way that they're going to be dealing with affected organisations throughout this period. So they've made a number of announcements, and the types of debts and lodgements that are likely to be affected are listed on your screen, which I won't go through in detail, but it could be the income tax returns which are coming up for lodgement, fringe benefits tax returns. There are activity statements and instalment notices which are going to be lodged between now and say 30 June that could all trigger debts for which affected organisations may need to be asking the ATO for some relief. Okay, so the type of relief that's being offered is largely to do with management of debt and assistance with cash flow. In particular, and I'll start with the top on this slide, is the deferral of debt, so payment deferral arrangements for any debts that occur between 23 January 2020 and 12 September 2020. So these are the key dates that the ATO are working within with respect to their relief options. In their eyes, that's when the pandemic really took hold and started affecting businesses in Australia, 23 January. And they're envisaging that business might begin to start to get back to normal around mid-September. So at the moment, with a lot of these measures, particularly the payment deferral option that they're offering, 12 September is the end date that they're working with. So this means that if you've got a debt that arises now and you've done your cash flow forecasts and you determine that you're not going to be able to pay it now, and you'd like a deferral, you would call the ATO and ask for a deferral, and they'd likely provide that up until the 12th of September, at which point the debt would become fully payable again. The second relief option that's listed on your slide there is what they're calling low interest payment arrangements. And the substance of these will probably vary from case to case in terms of exactly what low interest means and how long the payment arrangement is for. But I've spoken to the ATO and I know that in certain circumstances, they'll actually be interest-free loans. And the types of arrangements where that would be the case include where your GST, so say your activity statement debt is less than $50,000, you're willing to go on a direct debit arrangement to ensure the ATO's cash flow is assured. You're a smaller business and you haven't defaulted on any payment arrangements in the last 12 months and all of your lodgements are up to date. So provided those sorts of things are all ticked off, the ATO is willing to say, well, we'll put you on a payment plan for 12 months. Okay, so that you can distinguish that from the payment deferral option where you're not paying anything until 12 September. Under the low interest payment plan option, you presumably are paying something now and within the next month your first repayment would be due, but you're given up to 12 months to pay it off. The third item listed there is the remission of interest and penalties. And this could coincide with a payment deferral that you've requested or a payment arrangement that you've requested. But again, for any debts that arise after the 23rd of January, you can apply to the ATO and request that they remit those interest and penalty amounts. And if you can demonstrate that the reason that you haven't made the payment is due to how you've been affected by the COVID-19 pandemic, then the ATO would likely look favourably upon that request and remit the interest and penalties that have been incurred. And I would suggest that if you're not making payment at the time of making that request, then what you should be doing is asking for a payment deferral at that point in time, or asking for a payment plan to be put in place. The fourth dot point listed on this slide is something that's been available, that is available under normal circumstances, but the relief actually relates to penalties that can apply if you do it at the wrong time or under the wrong circumstances. So to explain that a little bit further, you can vary your March 2020 PAYG income tax instalment if you're an income tax instalment payer down to nil. So let's say, for example, your quarterly income tax instalment for March is $20,000. You can vary that down to nil. And that, of course, means that when you lodge your 2020 tax return, the amount of tax that you will have to pay will be $20,000 higher than it would be if you paid the instalment now. In addition to that, you can also claim a credit for instalments that have been paid for September and December 19 quarters. So again, if those were $20,000 each, you could claim a credit for $40,000, and that would be a cash flow boost at the moment, but again, would increase the amount of tax that you're paying when you lodge your tax return down the track. So the real relief that's being offered with respect to that dot point is you're not going to be penalised if you were affected by COVID-19 and you do vary your instalments. You're not going to be penalised by virtue of the fact that you do have tax payable when you lodge your tax return. Whereas under normal circumstances, if you vary your instalments down to nil and then you later lodge a tax return and you have tax payable, you can be penalised. So that's the relief that's being offered there. It's a self-assessment practice really, because we're all responsible for preparing and lodging our activity statements and instalment notices. So it's not something that you have to call the ATO about. So I would suggest that ensure you are actually affected by COVID-19 and you can demonstrate why you varied your instalments down and you have had negative cash flow implications that required you to do this, albeit that there's probably not going to be an automatic trigger for review when you do vary your instalments down. It is possible that down the track the ATO might look retrospectively at some entities who have done this and perhaps query why they've varied their instalments if it's not clear to the ATO that they were affected by COVID-19. So just make sure that you've got good justification for doing that one. The final dot point listed here in terms of the relief available that I'll be talking about is you can change your GST reporting cycle to monthly. If you're a quarterly lodger at the moment and you're expecting, having done your cash flow forecasts, to actually be in a refundable position, you might want to change your reporting frequency to monthly, which will obviously give you access to your refunds for the months of April and June sooner. Now you have to do that at the beginning of a quarter, which would be 1 April. So before the end of April, I'm sure if you give the ATO a call and request that, they would do that, but it will be effective from 1 April, and that will mean that your April GST refund will be available towards the end of May when you lodge that BAS, and May would be available in June as opposed to waiting until July. So the key actions that we're suggesting that organisations follow are listed here. There's probably a few others, but very importantly, make sure that you're preparing and updating your cash flow forecasts and you understand what tax liabilities are going to be coming up over the next 6 months or so, at the minimum, probably longer. And you're updating that regularly as business conditions and trading conditions change, but also as government announcements are made. That will assist you in determining whether you need to be applying for some of these relief options and when they might be triggered. Ensure your lodgements are up to date to ensure that you're actually eligible for the relief options when you apply for them. Make sure that you're still paying your employee superannuation. The super guarantee charge will still apply if you pay your super late. So make sure that you stay on top of that. There's no concession with respect to paying your employee super. We're encouraging early communication with the ATO. It's better to be on the front foot with these things. It's better to keep the ATO informed as well. So if your circumstances change, we encourage that you get in touch with them as and when needed. And apply for the relief. It's not automatic. It's something that you will have to apply for and demonstrate that you qualify for. And of course, contact us because we can assist with applying for these sorts of relief options. This slide here, before I hand back to Matt, just outlines some places that you can go for more information. The ATO has direct phone numbers that are meant to be used for applying for COVID-19 relief. If you're a small entity, the phone number is there. If you're a large entity, there's a different phone number there. There are 2 websites listed there. We've got an array of information on our COVID-19 dedicated page that you can refer to. In addition to those that the ATO have released in terms of their relief options, you can also consider lodgement deferrals and getting in touch with respect to applying for lodgement deferrals. And if you're a large business, you can contact the large business hotline. Lodgement deferrals are normally provided where your circumstances prevent you from lodging by the due date. So you might not have access to information, you might not have access to your accountant, key people might be unwell, those sorts of things might prevent you from lodging on time. So you can actually contact the ATO and request that your lodgements be deferred. So with that, until Q&A, I might hand back to Matt now and go from there.
Thanks, Blake. And great to see lots of questions coming through on turnover calculations, on contractors, on directors' eligibility. So just giving the panel some warning that there's some good questions coming up. Turning now to the states, and in particular, the Eastern Seaboard. There have been a range of announcements made predominantly, but not solely, on payroll tax concessions. My colleague, Tony Principe of our Sydney office, will outline these and their subtle differences. Tony.
Thank you, Matt. As Matt's noted, my intention is to run through the state stimulus measures while the job seeker announcements from last night probably usurp the importance of a number of these measures. I still think it's worthwhile contemplating them for their importance. Firstly, if I go through to New South Wales, in this particular instance, New South Wales is offering various concessions and support packages. The idea being to get further cash flow into businesses, as well as assisting with maintaining employment of employees and growing the employment pool. Firstly, in respect of payroll tax, the concession that's applicable is subject to a threshold. Firstly, that particular threshold is a $10 million threshold, and it's determined by reference to the Australia-wide group wages. So, provided in respect of any payroll taxable group, their Australia-wide taxable wages are less than $10 million, the concession that they'll be entitled to is a 25% reduction in the payroll tax liability for the 2019-20 year. The practicalities of actually accessing that concession are twofold. If you're a monthly remitter, there'll be no requirement to make any payroll tax payments in respect of the months of March, April and May. And once you lodge your annual reconciliation in July, that will then be determinant of your total liability for the year, and obviously it'll take into account the fact that you haven't made any payments for the last 3 months, and it'll be determinant of whether or not you have a refund or further payment to make. If, however, on the other hand, you are an annual lodger, in those circumstances, the 25% reduction will once again be determined on the basis of your annual reconciliation that ends up being lodged. The other concession that's referable to those entities that qualify to the 25% reduction is a deferral of payroll tax for a further 6 months. For those employers who breach the threshold, so their taxable wages are above the $10 million threshold, there is a deferral being offered for 6 months. In these particular circumstances, they won't be required to make their payroll tax payment on the 7th of April for the month of March. There are further details that are being finalised in respect of this deferral, and we expect those to be available on the New South Wales State Revenue Office site in the near future. Apart from payroll tax, New South Wales has also announced that they'll be deferring various state levies and fees. In particular, that when the announcements were made, the targeting was for those industries that had been quite severely impacted up until that point in time. So things like gaming and lottery taxes will be deferred for 6 months. In that particular instance, the deferral will only apply if there's evidence that the funds will otherwise be used for the purposes of retaining staff. There's also deferral of things like parking space fees, all of which are being deferred for 6 months. In a number of the instances, the expectation is that the payment will then due to be made in September of this year. As has been announced more formally on a federal sphere around rent relief, each of the states have implemented their own announcements in respect of rent relief. For New South Wales, for those commercial tenants that occupy premises that are owned by government instrumentalities and they have less than 20 employees, their rent will be deferred for 6 months. And finally, in respect of New South Wales, I note there's been a fund set aside, a New South Wales fund in the amount of $1 billion. The idea behind this fund is to allow for further employment opportunities. Examples of the use of that fund so far have included Service New South Wales hiring 1,000 employees, obviously to assist with the many queries and assistance that commercial ventures are requiring during these periods. And those funds have also been used for things like hiring further staff for the purposes of cleaning and maintenance contracts throughout the state. If I go on to Victoria, Victoria's relief in respect of payroll tax is quite different to the other states. In the Victorian circumstances, the threshold that applies is a $3 million threshold for the concessions to be available. That $3 million threshold, however, is applied only in respect of wages paid in Victoria and is applied on an employer-by-employer basis. So if a company group, as an example, has 3 employing entities in Victoria and each of them have a payroll tax bill for 2019-20 that is less than $3 million, they will qualify for the concession. The concession in respect of Victoria is a full waiver of the payroll tax liability for the 2019-20 year. So the intention in this instance is that there'll be a refund of payroll taxes paid already by entities that qualify. My understanding is that payments had already started to be made last Friday, so from the 27th of March. And for any further liability for the rest of this year, there will be no requirement to make any further payments. The entities will still be required to lodge payroll tax returns, but they won't need to make any further payments. Also, for the entities that qualify for the $3 million threshold criteria, there'll be a deferral of the first quarter's payroll tax for 2021, and the payments in respect of those quarters will not be due until January 2021. In recent days, the Victorian Government has also announced a further concession referable to payroll tax in one sense, and that is for those entities whose payroll taxable wages are less than $650,000 and aren't currently paying payroll tax, they'll be able to apply for a grant of $10,000 from Monday the 30th of March, so effectively from yesterday. The Business Victoria site has a link which allows entities to be able to make those claims. Victoria, like New South Wales, is also applying various concessions to other state levies, taxes and fees, be they deferral or waivers, as an example, like New South Wales, in respect of liquor licensing fees, Victoria will waive those. To the extent they've been already paid, you can apply for a reimbursement if you've made the payment in respect of the 2020 year. Further concession, which is probably quite limited, but is still relevant, is in respect of land tax. In Victoria, if you have at least one non-residential land holding and the total land holdings are less than $1 million, you can defer your land tax payments to 1st of January 2021. The State Revenue Office will be in contact with those entities that qualify for the concession, and if you've already made instalment payments, you'll be able to get reimbursed. Victoria also has rent relief that it has announced will apply in respect of commercial tenants of government instrumentality buildings. At the moment, details are still to be finalised in that respect, but there is rent relief that they have announced that they will be providing. Victoria has also set aside $1 billion of funds for a business support fund and a Working for Victoria fund. The one portion of the funds, so $500 million, will be provided for the hardest hit sectors, which include hospitality, tourism, arts, retail, etc. The government's intention is to work with the Victorian Chamber, Australian Hotels Association and Australian Industry Group to work out what practical methodologies can be put in place to try and keep people in work. The other $500 million of that fund will be used to assist displaced workers to find new opportunities, transfer to new roles, develop their skills and get support as necessary to get them into a new role. For those individuals that might want to access the parameters that have been set up to help them in that regard, they'll need to register online. The last item I've noted there, which Victoria has announced, and I presume the other states will do something similar, is that they'll be fast tracking all invoice payments, so that the intention is that all invoice payments will be paid within 5 days to obviously assist commercial ventures with their cash flows. Finally, in respect to taxes, I've got Queensland as well to describe to you. Once again, like all the other states, Queensland has also announced concessions in respect of payroll tax. Their thresholds are also done in a similar fashion to those that apply for New South Wales, and that is the thresholds are measured against Australia-wide group wages. For those entities that have Australia-wide group wages of less than $6.5 million for the 2019-20 year, they'll in fact be able to obtain 2 months refund of payroll tax. So they'll be able to get their payroll tax back that they've paid in respect of January and February. Secondly, there'll be a waiver of payroll tax for 3 months. So for the months of March, April and May, they won't have to pay any payroll tax. And finally, there'll be a deferral of any further payroll tax for the rest of the year until 14th of January 2021. Deferral itself is actually something that needs to be applied for, and at State Revenue Office Queensland have set up links on their sites to allow you to apply for that deferral. For those entities that breach the $6.5 million threshold, they'll also be able to apply for 2 months refund of payroll tax, once again getting back whatever they've paid in respect of January and February. They'll also be able to claim a deferral, so they won't have to pay any payroll tax referable to Queensland for the rest of the calendar year, with the payment being due on 14th of January 2021. In respect of those particular payroll tax payers, they'll need to apply for both the refunds as well as the deferrals, and part of the application will require them to be able to show that they've been adversely impacted by the coronavirus. The impacts can include things like drop in sales, drop in customers, supply contracts being impacted, etc. The site itself has examples of the types of circumstances that qualify. As I've noted earlier, each of the states have also waived various other state levies. In Queensland in particular, they're focused on the industries that have been severely impacted in their sector, in particular tourism, liquor licensing, and the fees associated with those particular commercial ventures will be waived. Details are yet to be finalised in that respect. I should note as well at this point in time that the Brisbane City Council has also determined that where commercial ventures are operating within its precincts, that a number of the fees that the council would ordinarily charge will also be waived. So it's worthwhile contemplating if you have operations in various councils to determine whether or not they are providing rebates on council rates, etc. As per the rest of the states, Queensland has also announced that it will provide rent relief. In that instance, it'll be 6 months of rent relief for businesses that are renting, once again, from government instrumentalities. Queensland, unlike some of the other states, is also set up a $500 million fund to provide low interest loans. So entities will have the capacity to apply for up to $250,000 of loan funds with at least 12 months interest free in respect of those loans. Applications are currently open in respect of those loans, and the intention is there to assist businesses to retain employees and maintain their operations. The application mechanism has been set up through the Queensland Rural and Industry Development Authority that have online services to assist in that regard. As per New South Wales and Victoria, Queensland has also set up worker and industry support funds, 500 million of which will be once again aimed at assisting workers to find new jobs. But in particular in Queensland, they're focusing on assisting those to work in the sectors that they require particular support on. So it's things like transitioning to healthcare, agriculture, food production, transport, cleaning and mining. Apart from that, Queensland has also set aside $1 billion to assist large business entities during the transition phase while the virus concerns are still in play, and secondly, to support them to scale up once the transition period is over. In this regard, once again, Queensland being quite parochial will focus on those industries that make the most significant contribution to their state. The last thing, while it's not particularly significant, it's worthwhile noting there is an electricity rebate that will apply automatically to small and medium businesses, provided the businesses are using less than 100,000 kilowatt hours on their next electricity bill, they should be receiving a reduction of $500. So back to you, Matt.
Thank you, Tony. So Tony mentioned the states were introducing some form of rent relief, mostly as they relate to government buildings. You may have heard that the federal government also introduced measures over the weekend concerning commercial tenancy relief. Simon Tucker, just bringing you into the discussion, can you explain to us how or if these announcements may interact?
Thanks, Matt. So I'm just catching my breath after answering all the Q&A. Keep them coming. Yeah, look, there's not much guidance on this. My feeling is that probably would interact quite well, and this is on the basis that on Sunday evening, the National Cabinet announced a set of principles which was endorsed by the state and territories to support those with rental stress, I suppose. They released a number, I guess it is a statement of principle, so details are yet to come. But what was announced that the state and the state governments would be supporting a temporary 6 months moratorium on eviction where we have a non-payment of rent, and that's to be applied across commercial tenancies that are severely impacted by by rental distress as a result of the coronavirus. There would also be an understanding that in many cases there would be a reduction or waiver of rental payments for a certain amount of period that for tenants that are adversely affected. And in some cases there would be support from the government to terminate leases or seek other mediation or conciliation where there is grounds of financial distress arising from COVID-19. Now, importantly, it was made clear that these, I suppose, principles or whatever they end up being in their final form will only apply to businesses that are at financial distress as a result of COVID-19. And so landlords and tenants will be expected that are not significantly affected by the coronavirus would be expected to still honour their lease obligations and rental agreements. And so more details to be released, but my feeling is they probably will interact quite well given that they are coming direct from government. Thanks, Matt.
Thanks, Simon. So there's been a number of questions that have been asked through both the Q&A button and the online chat button. We have been answering many of these as the webinar has proceeded. However, I might now turn to the panel and I'll group many questions together because some have very similar veins. This first one is to Simon as well. Simon, lots of questions coming through on this concept of turnover, both as it relates to the JobKeeper package, but also on the depreciation investment allowances. Can you explain the concept to us and the importance of it?
Thanks, Matt. So I might just first start with the turnover concept for the JobKeeper payment. At the moment, there's very little information available on what is meant by this. All we have is an announcement by the Prime Minister and a fact sheet released by National Cabinet. So there's very little information on this. And so it may well be aggregated turnover, or maybe simply turnover of the particular entity that is paying employees. I would suspect it's probably aggregated turnover. That's what's been used across all the measures so far, but we'll only really know that once more data is released, and I suspect that will be when the legislation is released, or in actual fact when the Finance Minister drafts the legislative instrument entering into law. In terms of aggregated turnover, what is it? Well, it's, as James has said throughout his presentation, and just to clarify, it's worldwide turnover. So worldwide turnover from carrying on a business. And so you may have a very, very small, or you may be a very, very small cog in the machine of a very large machine, but your turnover is grouped with your, I suppose, your overseas parent or your parent in Australia even. And so turnover grouping is generally done at a 40% ownership threshold. And so if you own more than 40% of another entity, or if you're owned by more than 40% by another group of entities, your turnover will be aggregated. There is provision for the Commissioner to allow discretion where you're at 40%, over 40%, but under 50% to de-group you for aggregated turnover purposes. But I guess what that will mean is your payments are unlikely to be automatically credited, because that discretion is something you would need to apply for and something the ATO would need to consider and allow.
And Simon, a follow-up question to that. A couple of questions coming through in relation to partly owned companies. If a company is owned 40%, would that be included in your aggregated turnover, or do you need 50% or more?
Yeah, 40% is the magic number for automatic inclusion. If you are above 40 but below 50, there is a discretion that the Commissioner can allow you to not be grouped in with that other entity. And so that is something you need to apply for. And as I said, these application processes can take at least 4 weeks. And in this scenario we are in now, where the ATO is under pressure to turn around other things, it's probably likely that it'll be a lot longer than 4 weeks. And so what does that mean? It means that if you've lodged your tax return in the previous year showing you've got more than 50 million aggregated turnover, it means that you're unlikely to get the payment automatically. This may be something you have to apply for on a retrospective basis.
So Simon, while you're running hot, a couple more on the JobKeeper announcement, not surprisingly. there are many questions coming through in relation to how you prove that there's been a decrease in turnover. So for those over $1 billion, you need to prove a 30% drop. For those under $1 billion, you need to prove, for those over $1 billion, it's 50%. How do you prove that? Would management accounts be enough? And secondly, over what period of time do you need to prove the drop? Do you compare this month to last March, for example? Are there any details in relation to the mechanics of the calculation?
Yeah, all great questions, Matt. I'd like to firstly say this, as I said earlier, there's very little detail around the mechanism of how this all works. I guess so we can only speculate. What I suspect would be appropriate is if you did have a set of management accounts for, say, the March period and compare that to, say, perhaps the February period, or perhaps to the March period of last year, that might be sufficient to convince the ATO that there's been the requisite 30% decline in turnover. That's my opinion. I think that would be sufficient because I suppose March is kind of the trigger month where the eligibility kicks off from. In terms of what is turnover, I see there's been a few questions on the Q&A line asking what is it measured on? Is it accounting income? Is it taxable income? Again, no details released on that, but my feeling is it's like, given this law is more closely aligned with income tax concepts, that the notion, and administered by the ATO, that the notion of turnover would probably be determined as assessable or taxable turnover, because that's something the ATO is more readily able to verify from its own systems, I suppose.
And just one last one that we'll ask before we get on to some other questions on the JobKeeper. Contractors and non-executive directors, is there any clarity as to whether they would be eligible under the scheme?
Yeah, interesting question. I'll probably deal with non-execs first. I think they would still be, again, details haven't been released, but I would be of the understanding that they would still be considered employees from an income tax law point of view. And so if you had non-executive directors receiving salary or executive director payments, then, and you met the qualifications, the other eligibility criteria in relation to that employee, then I think you'd probably qualify, so long as you had the requisite 30% drop if you're under $1 billion, or 50% drop in revenue if you're over. For contractors, again, no details, but what I think we'll see is contractors that aren't employees for income tax purposes. So that is, they're not being paid through the PAYG system, they're being paid through an ABN. I suspect they won't create an entitlement to, the employees won't create an entitlement to the $1,500 on their own account. However, these provisions apply at the level of employer and self-employed, and so it may be possible for that subcontractor or contractor to make an eligibility application of their own to the ATO, because there is provisions for that. And so, and the details of how that all works is kind of yet to be determined. But for example, if you were like physios and other non-medical health care professionals would have significantly cut their hours, so there may well be entitlement if you're a self-employed subcontractor like a physiotherapist or a myotherapist, or even someone like I'm just trying to think, like a hairdresser that may operate through an ABN. Thanks,
Simon. Tony, a couple of questions for you, directed towards yourself, I suspect. There are a number of questions in relation to this concept of threshold. In Victoria, I think you explained that it was $3 million. Tony, can you explain this threshold concept in more detail? What are we looking at in terms of threshold? What's in the threshold? What's not? For example, do bonuses fit within threshold? And then, is there any pro rata? So if your wage bill is over $3 million, do you get some benefit or pro rata of the concession on offer?
Thanks, Matt. I'll start off with the last bit of that question first. Unfortunately, there is no prorating of the concession. If you breach the $3 million threshold, there's no remittance of any of the payroll taxes that are payable throughout the year. The payroll tax liability will still stand. The $3 million threshold is applicable to the payroll taxable wage bill of the entity for the 2019-2020 year. So it's essentially all the salary and wages, allowances, etc., that an entity would include on its payroll tax returns on a monthly or annual basis get aggregated for the year from 1 July 2019 through to 30th of June 2020. Provided that number is going to be less than $3 million, then the entity does not have to pay payroll tax in Victoria. In respect of the question around bonuses, yes, bonuses as their remuneration or salary and wages, if they're paid during that payroll tax year, they'll get included in the calculation to determine whether or not you've breached the $3 million threshold or not.
Thanks, Tony. There are a number of new questions coming through on the JobKeeper package. So it's certainly creating lots of interest. Simon, back to you on a couple of these. Firstly, do the announcements apply to not-for-profits?
Yes, sorry, I'm just answering questions on the line. Look, no specific details on this, but from what I can tell from the release, I don't see that there's an exclusion. I think all there is, I think people, what everyone needs to remember, these measures are designed to support and maintain the salary of employees. And so when all the media around this was released and leading up to it was all around, the question was, were this support payments going to be administered through Centrelink or how are they going to be administered? Now, I think the way to look at this law is the entitlements are simply payments to employees from the government to subsidise their wages or to support them if they have lost their jobs. And so from that perspective, it's the critical thing is that the employers are really just the administrators of the payment for the scheme. And so on that basis, I would think that not-for-profits would be as entitled, or employees of not-for-profits would be as entitled to these measures as a tax-paying employer. Again, legislative instrument hasn't been released on this yet, but I would have a strong feeling that would be the case, that an NFP would have an entitlement to these payments. Again, there's an obligation for the employer to make a payment of the $1,500 through to the employee, and so there should be no net benefit no financial benefit to the employer, apart from having the ability to keep their employee on where they may otherwise not have.
Thanks, Simon. One question which is a great one, which I'll pose to the entire panel, and perhaps Blake has a view here. Excluding the JobKeeper payments, what measures apply to an operating subsidiary that doesn't have any employees? So obviously many of these concessions are aimed at keeping jobs, keeping people employed. Not all businesses employ people. A question to the panel, are there any concessions available for those businesses that don't have employees?
I'm happy to kick things off. I think it's a good observation. I think a lot of the concessions that have been announced are targeted at businesses retaining their employees. So for those businesses that don't have employees, that they may feel like they're missing out, there are some things that are available in terms of the ATO administration relief that we've gone through. So I can just touch on those again quickly, but for example, if you're a quarterly reporter and you're expecting GST refunds, you can change to be on a monthly basis. You can also consider varying your PAYG income tax instalments that have been paid already for the year. And I noticed that one of the Q&A questions was, if you're a monthly PAYG instalment payer, can you also vary those? And I don't see any reason why you wouldn't be able to. And all, obviously the payment arrangements and payment deferrals that the ATO are offering, they're not exclusive for PAYG withholding. They're available for GST debts and fringe benefits tax debts and income tax debts. So absolutely, you can make use of those. Happy to throw it over to anyone else who might have some other thoughts on that one.
And also on top of that, the incentives for investment allowances, the instant asset write-off, and also the accelerated depreciation, they don't have an employee test. So those are also potentially eligible depending on the turnover.
Well, I am conscious that we have reached 10:30. Clearly, there are many questions here that we could keep going on. However, for those of you with unanswered questions, we will do our best to answer these for you, or at least direct you to someone you can have a discussion with. You can contact me or anyone on the panel, or of course your usual ShineWing contact to further the discussion. We will email these slides to you this afternoon. We have also included a fact sheet on the JobKeeper announcements on our website for more information. On behalf of you, the participants, I'd like to thank the presenters, James, Blake, and Tony, and Simon for answering the difficult questions. We look forward to connecting with you further in the future, and of course, we all look forward to the day when we can meet face to face. With that, please take care and thank you for your participation.